There's a lot of bad news. So from people saying sell the rally to car repossessions that are skyrocketing, massive warnings for the market, and a Federal Reserve that Nick T just tweeted is expected to evaluate. How are these lags affecting the market and the economy? Especially since this time seems different. After all, we are coming out of a pandemic and are in war. How is this going to affect markets going forward? And what are my thoughts about Jerome Powell and the Federal Reserve's activity coming up this week? Find out in this video. And remember, you want to build your wealth investing in real estate, stocks, buy, sell alerts, portfolio reveals. You want to look at partnerships that we have in the do-it-yourself property management group, rental renovations, build your wealth with elite hustlers, making more money as an employee or self-employed, starting a business. Check out the programs linked down below, building your wealth and on making more money. I'd love to join you in the private course member live streams, and we can dialogue directly. Anytime, lifetime access. Thanks so much. Check it out via the link down below. Expires tonight. Best price guaranteed. More Americans are now living paycheck to paycheck. You've got a repo crisis going on in the cars market. You've got craziness coming to the Federal Reserve this week, and many analysts saying don't chase the rally. What do we believe? What do we think? Let's talk about it. But always remember, the coupon code expires today, January 30th. Check that out, link down below for the best price possible. At least guaranteed for the next 3 months, if not likely much longer. You get lifetime access. First, the share of Americans who say they're living paycheck to paycheck has now moved up. Now 64% of Americans say they're living paycheck to paycheck. That's an increase of 3% from last year. And on top of that, 8 million people out of that group earn more than $100,000 per year, yet half of the people earning more than $100,000 per year say they are now living paycheck to paycheck, up substantially also from last year. This comes at the same time as in America, we're worried about a big recession coming. Germany telling us, no, don't worry, everything's fine. We're not going into a recession. And then literally days after, about 2 business days after, Germany says, don't worry, we're not going into a recession. Chancellor Olaf Scholz, alles ist gut, everything is great. What happens? Oh no. GDP numbers come in for Germany showing a 0.2% GDP decline. And Germany's, of course, a manufacturing hub and a much greater than expected pullback. Sadly, potentially pulling Germany into recession. But we got to talk about America because, look, even though we've got the Federal Reserve coming up this week, why has the market been rallying? Well, Mike Wilson says the rally is something that you should not chase. Mike Wilson is, of course, the bear from Morgan Stanley, and he tells us the reason we saw a rally in January is because of the seasonal effect of people selling in December, potentially tax loss harvesting, and then getting back into the dip opportunity or FOMOing in on some short covering after December. Mike Wilson reiterates, do not fight the Fed. And remember that, and this is another piece that I found, but something to keep in mind is the last time we had a January that moved as much or nearly as much as it did this January. This has been the best January since 2019. Or the last time in 2019, January ended up popping up markets 8%. And now we're up about 6% in January, which again is the best January since 2019. But the difference between then and now was that in December of 2018, actually right around the 18th, 19th, and 20th, the Federal Reserve U-turned, and individuals thought they were going to continue hiking, and they did not. This is obviously before the pandemic, and we had a pretty bloody December. And so that was the last time we had a great January, when the Fed actually moved. The Fed has not moved at all. In fact, it's expected that Jerome Powell's probably going to keep on a pretty nasty mask this week. That's because as stocks are starting to slip up a little bit or start rallying up a little bit, which is a slip for the Federal Reserve, we're seeing a slipping in financial conditions. Financial conditions in the last 3 months have started to loosen. And while on one hand, looser financial conditions is good for avoiding a recession, the Federal Reserve does not want financial conditions to get so loose that we end up leading inflation to rise again. That would be the biggest risk. And so my belief is that Jerome Powell is going to have to keep a very ugly mask on when he ends up talking at the press conference this Wednesday. We widely expect a 25 BP hike. We're not expecting any kind of move away from a 25 BP hike, but we're expecting Jerome Powell to probably reiterate what he gave us in the summary of economic projections in December. Any move off of what he told us in December would probably be seen as bullish, especially if he softened the stance. I don't think he's going to be more aggressive based on what he reported in his December summary of economic projections with the rest of the Federal Reserve staff, because data has actually come in weaker than when we had the Federal Reserve meeting in December. We've had weaker inflation, we've had weaker manufacturing numbers, so I'm not expecting a Fed that is going to be more hawkish than December. Now, personally, that could actually be a good thing because it could mean that we're not going to get talked to so dirty that the market ends up selling off. But I would caution against a lot of bullishness, mostly because I believe it'll be Jerome Powell's job to make sure he makes it very clear that he thinks we're still knocking on the door of a recession, that the 0.5% GDP estimate for 2023 is still his base case, that we're going to narrowly avoid a recession, but a narrow avoiding of a recession, in the words of the Fed, is probably, in the words of the market, a recession. And I wouldn't be surprised for him to reiterate the need to drive the unemployment rate up to 4.6%, which is what the Federal Reserve Board together reiterated in December, in addition to hiking rates to about 5.1% at a terminal rate. Right now, we sit at about 4.25%, and if we get to about 5%, which would be 3 more 25 basis point hikes, we'll be at that 5 to 5.25 rate hike, which we expect from the Federal Reserve at their terminal rate. Now, the bond market is pricing in rate cuts at the end of 2023, but I expect Jerome Powell to reiterate what he said in December. We're not even talking about rate cuts. That's okay, though, because when the Federal Reserve is convinced, and this is the beautiful thing, and this is why I do not expect to see this now, but when the Fed is convinced inflation is gone and wage inflation is gone, what is the Fed going to do? Well, the Federal Reserve can very easily, in my opinion, maintain their credibility by making the following very simple. Hey, look, we have a policy called FATE, Flexible Average Inflation Targeting. We believe that the average inflation rate for PCE is going to be 2%. We don't actually have to have the every single month's read be 2%. This is an easy way for them to back off the idea that inflation needs to be 2%. They could let it be a little higher for longer while still softening conditions, right? On top of that, I believe that once they're convinced inflation is gone, which is not yet, they can very, very quickly U-turn and stop the bleeding in the jobs market and actually prevent wage loss from going as high as they projected in December. I really believe December is the Federal Reserve trying to shoot ahead of the running deer. In other words, inflation has sort of been this running deer that's been getting away from the Fed, and the Fed has been following it. But they've always been lagging it in all of their summary of economic projections over the last year and a half. The Federal Reserve has been wrong. They've had to revise them up, and up, and up. Now, I believe the Federal Reserve has finally given us a December report where they've actually come out ahead of inflation by becoming so aggressive. And I think now the Federal Reserve doesn't actually need to be more aggressive, especially since that inflation data and manufacturing data is now coming in softer. I think the Fed is just likely to maintain what they iterated in December. So if I had to sort of simplify the messaging for what do I think we're going to get from Jerome Powell, I want to make this very clear. I do not believe we are going to get more hawking than December. I believe we'll probably stay consistent with the December hawking. Consistent with December hawking is basically just referring to the summary of economic projections from December. I think that's the easiest punt that Jerome Powell could do. He could go up, give his statement, answer the Q&A, and basically just punt the February meeting all the way to March. Just, hey, look, we're doing 25 BP, still waiting for more data. Look at the summary of economic projections of December. That's our opinion. Nothing's changed. That, again, it's not really bullish, so I wouldn't call it heavily bullish. I don't think we're going to get a massive sort of softening position from Jerome Powell. And I don't believe we're going to get more hawking. So I actually think what we're going to get is a very neutral Jerome this time. Now, it is possible, it is possible that neutral ends up being considered bullish because it isn't more hawking. I think a lot of folks believe that because markets rallied in January after that December disaster, the Fed has to turn into a hawk. I do not believe that is true. I believe the Fed will see that financial conditions are still substantially tight. 10-year Treasury yields are still sitting around 3.5%, also again, substantially tight. And any kind of little rebound in the stock market we've seen is actually good for the purpose of avoiding a recession. Remember what they're trying to do. They're trying to thread a needle here. They're threading a needle suggesting, hey, look, we don't want things to be so tight that we definitely have a recession, but we don't want things to be so loose that we recreate inflation. We just want things to be, sort of in the middle. And that's where I think the Fed's in the right place to just be neutral this time. Jay Powell, if you're watching this, man, I would love to be at those FOMC press conferences so I could throw you some softballs, daddy. Okay, no, I think it'd be really cool to have some YouTube representation over at the Federal Reserve. But in the meantime, I'm not too nervous about Jay Powell on Wednesday, and I think that is okay. This is despite the fact that you have JP Morgan and Morgan Stanley saying sell the rally, Bank of America saying they expect us to move from job gains in 2022 every single month to job losses in Q1 of 2023, as high as 175,000 job losses per month coming in Q1 2023. That would be a massive flip. Something that markets would not be very prepared for, I think. But remember, we've known this since, quite frankly, forever. But I've been talking about this since January of 2022. For over a year, I've been talking about this. Job losses lag recessions. So quite frankly, the fact that everybody keeps focusing on job losses for me is just ludicrous because we know job losses lag a recession. So the worst could potentially already be behind us. We'll see. Hedge funds don't seem to think so, though. The Commodity Futures Trading Commission just released data that there are 2.4 million contracts on treasuries with massive short bets. Massive short bets. We are more short than we have been in quite a while on treasuries. Let me explain briefly what that means. When you are short treasuries, you believe that prices for treasuries are going to go down. When prices for treasuries go down, what does it mean? It means, short sellers and hedge funds think that interest rates on yields or on treasury yields are actually going to skyrocket. So if you think yields are going to go up, you take the Michael Burry approach and you short. Look on screen now. I'll hide myself here for a moment. Traders have never been this bearish on treasuries. Aggregate treasury shorts, the highest level of short selling since we have seen, you can kind of see it tapers off to nothing going all the way back to 1993 there on the left. But on the right of this chart, we are at the highest level of short interest on treasuries that we have ever seen. This is substantial. Now, again, hedge funds like to hedge. So if things are getting better, great, go long stocks. If things are going to get worse, maybe you hedge by shorting treasuries, especially since the Federal Reserve could end up telling us that they believe the neutral rate is closer to 4.8 to 4.9%, in which case we have more work to do, given that right now we're sitting at about a 4% lower bound on the Fed funds rate, and we need to see that move up via 25 basis point hikes throughout potentially the next 3 cycles. So keep that in mind. We're probably going to get to 4.5. Let me make this very clear because it's the 25 basis point brackets are a little confusing. We're at 4.25 to 4.5 now. We get a 25 basis point hike, we'll be at 4.5 to 4.75. Get another 25 basis point hike, and we expect that for Feb. We get the next one, we'll be at 4.75 to 5. We get another one, we'll be at 5 to 5.25. And this is why markets are expecting we will potentially pause in May at 5 to 5.25. That would be slightly above that neutral rate, which the Fed has been talking about getting to for a while. Then the question just becomes, how long do they pause there, and how soon do we cut? I don't believe the Fed will be very inclined to give us many hints for that in this next FOMC meeting, but we'll see. What's worse, though, potentially, is not exactly what the Fed is doing, but what's going on with the car and auto market. Because a lot of folks are saying that the auto market is in a straight up bubble. In fact, the Federal Reserve just released its Q3 monthly rate of cars financed, and folks, in Q3 2022, it shot up to the highest level ever, growing to $41.2 billion of vehicles financed in Q3, which could coincide with high vehicle prices and high financing costs. But in terms of nominal loans financed, high vehicle prices probably are what helped drive this highest ever level of vehicles financed. And that was in the third quarter of 2022, roughly matches the rise in inflation that we've seen, but it doesn't help that interest rates also doubled over the last year, and delinquency rates are starting to rise, especially for subprime borrowers, leading the analyst firm Fitch and credit rating firm Fitch to warn for a massive wave of incoming vehicle defaults and repossessions. In fact, some banks are now reportedly increasingly speeding up how fast they could repossess cars so they can sell them, obviously at a loss, but less of a loss than if they waited to repossess the cars longer. Think about it. If car prices are plummeting, then you want to and your borrower stops paying, you want to repossess that car as soon as possible so you could dump it on the market and get a lower loss than you would have otherwise if you were holding on to that slippery slope of prices plummeting. So far, we are still seeing the default level on vehicles rise just roughly to 2019 levels, no exceeding of those default levels yet. However, Fitch does believe that very soon, the lowest income subprime borrowers will exceed the default rates that we saw in 2019, not getting to the default rates that we saw in 2008, but still a substantial amount of additional pain. Now, some of the reasons for this. We kind of set up the perfect storm for subprime borrowing. You basically masked people's bad credit scores due to the pandemic because it was impossible to be late and to get a bad credit score during the pandemic. Well, nearly impossible. You got a bunch of money from the government, unemployment money, stimulus checks, you name it. On top of that, via forbearance and you not needing to actually make your payments, leading a lot of credit scores to actually increase during the pandemic. Combine higher credit scores with a massive car shortage, high interest rates, chip crisis, and massive run-up in vehicle prices. What you have is people masking how qualified they actually are via higher credit scores. So higher credit scores, higher interest rates, higher prices, and gas prices running up. You have a recipe for disaster in car affordability. And so now, since over the last few months, about the last 4 to 5 months, we have seen a substantial tick up in the number of 30-day lates and the number of 90-day defaults. There's this individual on Twitter called the Car Dealership Guy. He's been talking a lot about this problem, but he recently noticed that he believes banks are so worried about repossessions on one hand that they're increasing how quickly they're repossessing cars, but on the other hand, they're so morally amorally, you'd almost call it, amorally incentivized to keep lending, to keep their profits to potentially rising. What they're now doing is they're repossessing cars faster on one hand, but on the other hand, they're waiving requirements for loans so they can keep making new loans. So it's kind of crazy. More people are defaulting on one hand, but they're actually making it easier to get a new loan on the other hand. That's because they're starting to waive what's known as the open auto stipulation. This is when you go qualify for vehicle financing and it shows you already have an open auto loan. You're not supposed to qualify for another one unless you can make both payments. Well, now apparently lenders, according to Car Dealership Guy, are starting to waive that stipulation, making it easier for people to buy a new car, even as banks are worried about this crazy flood of repossessions. The Car Dealership Guy says this is stupid, especially since many people are underwater on cars they've bought over the last 2 to 3 years. Usually people who are underwater have to pay money. You have to feed the kitty to sell your car to buy a new one. Feeding the kitty means taking thousands of dollars out of your wallet to buy a new car and pay off your old one. But most people don't have that money. So at the same time as defaults are rising and repossessions are skyrocketing, you actually have banks going, but let's keep the funnel full and let's keep lending as car prices are or have already fallen 30% are continuing to fall. This individual believes that repossessions could end up getting ugly, and this is really bad for the car market. Elon Musk even went as far as replying to this, saying, "Good prediction." Yikes. That's not so good. On top of that, we also have potential inflationary pressures, which continue to get talked about from China and wages. Consumption is expected to and hopefully be the main driver of the economy per the Chinese government. But consumption is actually not the main driver of the Chinese GDP. Now, in my opinion, I actually think that could keep that second wave of inflation down, but we'll see. Chinese government really wants to propel spending in China. Household spending as a percentage of GDP is only 38% in China. In the United States, it's 70%. So in other words, the individual consumer makes up 70% of the US economy, only 38% of the Chinese economy. Much of the other portion of the economy in China is the result of the housing boom. But the housing boom has turned into a massive housing bust. How quickly will individuals come back into the housing market, even with lower restrictions on housing? Nobody knows. So we'll see. Fortunately, though, back in America, we have a piece by Morgan Stanley suggesting that you can stop worrying about wage price inflation. And even though Morgan Stanley overall is pretty bearish, they suggest that because of more concentration of jobs, that is more like larger and fewer companies having more jobs, leading to less competition amongst other companies, leading to higher profits for those companies, and lower unionization, ultimately should keep a lid on wage prices. We'll see. So if we put all of this together, look, there's a lot of bad news. You got a lot of analysts screaming about sell the rally, it's a bear market rally. You've got Germany potentially walking into a recession even though they didn't think they would. You've got a repo crisis going on in the cars market. You've got this potential for a second wave of inflation in China. I personally believe, and this is sort of my summary of it, I don't believe a second wave of inflation in China is really going to lead to a lot of pain in the United States. I don't believe the conditions are present for a wage price spiral, though we want to pay attention to that. Even though the auto bubble may be present, it is not anywhere near the levels of the 2008 crisis. It's still at about half the levels of 2008. And yes, poor individuals are going to suffer the most, as usual, in a recession. I don't believe that the Federal Reserve necessarily has to push us off the cliff into a deep, dark recession. And whether or not we have a recession, I believe the United States will be relatively resilient over the next decade. And once we get through this temporary madness, we're off to the races for the rest of the decade. And chips will be the next new gold with pricing power for the rest of the decade. We'll see. Right now, chips aren't doing that great. Chip equipment companies seeing sales fall 30 to 50%. But it seems as though a lot of that pain has already been priced in. So, what do you think? Is the Fed going to talk dirty to us? Are some of these smaller embers of pain, like in the repos market and in China, going to lead to an explosion of pain and the reiteration that you should never fight the Fed? Or are we facing that Nike swoosh recovery where, yes, there are hot spots, but we're going to get through those. We'll get through China, we'll get through wages, we'll get through inflation, we'll get through reopening, and we'll get through the repos crisis in cars. We'll get through all of that, and we'll just slowly keep chugging along. That's my belief. It doesn't necessarily have to be yours. But if you want to chat with me about your opinion, make sure to join the courses on building your wealth link down below. Today is January 30th, the day the coupon code expires. And that's it. We're moving away to higher pricing, and a lifetime access is yours if you sign up via the link down below for any of those programs on building your wealth.